Students,
minus code ratio.
Today we are taking the topic how to treat the goodwill, the treatment of goodwill. Okay. So in different conditions and in different situations, we treat the goodwill in different way. Number one, when goodwill appears in the books, when there is already goodwill is there in our balance sheet before the retirement of the partner. In that case, first we first of all this write off this goodwill. Okay, how do we write off the goodwill? As we have already studied, we debit all the partners with their profit sharing ratio and credit the goodwill in the same way we were doing earlier. So what the entry in first case we put the journal entry partners capital account debit and all partners partners capital account debit to goodwill account for goodwill written off and all partners capital account will be debited in their old profit sharing ratio. Okay, this is the first condition. Now in second condition, when the partner is going, he should be given some part of the goodwill. When partner is going, he is entitled for the share of goodwill, because for so many years, if some years he also worked because of that there is this business earned goodwill, so he also is entitled for the goodwill while retiring. So for that, if that goodwill can be raised in full value and raised in retiring partners in the value of retiring partner shares. First of all, when it is raised in full value, if 4 partners are there, the value of the goodwill is 60,000, 4 partners are there. So first of all, what we do, we credit that goodwill into the account of all the partners. Okay? All the partners. Goodwill account debit, that is raised with the full amount, that is 60,000. If here is 60,000 is the value, this full amount will be shown here. And goodwill account debit to 4 partners are there, A, B, C, D. A is capital account 15,000 if all are equal partners. So 15,000 to B's capital account 15,000, then to C's capital account 15,000 and to D's capital account 15,000. Okay. After this is raised, now what we will do? Now the second, because we cannot keep this goodwill into our books, and a self-generated goodwill cannot be kept in the books of accounts for longer period of time. Immediately we have to write it off. Now what we will do? This goodwill is there. Now what we will do? We will credit the goodwill and debit all partners capital account, existing partners, not the retiring one. So here if D is retiring, so he will get 15,000. Remaining all partner will be. Second entry is A's, B's, C's, capital account capital account debit to goodwill now, which was debited earlier, now will be credited here to goodwill account with 60,000. Now this goodwill will be debited in these partners capital account in gaining ratio, because they are equal partners, so it will be divided among them in 20, 20 and 20,000. So A's capital account will be 20,000 debited with 20,000, B's 20, C's account will be debited with 20,000, and goodwill will be credited with 60,000. This way goodwill debit, goodwill credit, so it will be it is raised, but same time it is written off. And now what happens here? A got 15,000, but he paid this 20,000. And here raised 15,000 debited with 20,000 means 5,000, 5,000, 5,000. These three are giving 5,000 from their capital, and which is credited to D's capital account, because D is getting 15,000 ultimately. And this way his account is credited. So this is the way when the full value, the goodwill is shown in the full value of partners capital account. Okay. Now the third condition. Third condition is what? When the goodwill is raised for the value of the share of the retiring partner. Now the same question we take here. A, B, C, D are the partners. B retires from the firm, and at that date the goodwill is valued 60,000. Okay, and they are the equal partner. 1, 1, 1, 1. Okay, they are the equal partners. 60,000 value is calculated of the goodwill of the firm. Now this goodwill is to be shown and is to be raised at the value of the retiring partnership. So here now how much he is getting? This share is how much? 1/4. So 1/4 of this 60,000 will be goodwill account debit 15,000 to this what is that? To D's capital account, and his account is credited with the share of his goodwill, and then this goodwill, that is 15,000. Now this 15,000 here we will write off this thing, and this is the A's, B's and C's capital account debit, and 5,000, 5,000 and 5,000 to goodwill. This is written off on that side. So these are the entries. If with the value of the retiring partners amount, this value of this goodwill account is opened in the books. Okay. Then when goodwill account is not raised, that is the fourth condition. So in that case, what happens? We just this partner's capital account is debited and to the retiring partner's capital account. Means the same question is there, and ABC are the equal partners. They are the partners. They are sharing the profit in the equal ratio, and D retires from the firm, and on that date value of goodwill is calculated rupees 60,000. So and goodwill account is not raised in the books. In that case, what we will do? Partners, this who is retiring? D is retiring. So to D's capital account, he will be getting. So how much amount he will get? This 15,000 and A, B and C's. Okay? Capital account DR. Capital account DR. Capital account DR. How much? 5,000. 5,000. 5,000. Now these are debited and these credited, and this way there is goodwill account is not raised, but their account with the debit and credit in their account, and this amount of goodwill has been credited to D's capital account. Okay.